Good evening, everybody, and welcome to this special presentation of Smart Retirement Tax presented by ChappelWood Financial Services. My name is Damon King. I'm a certified financial planner professional and wealth manager with ChappelWood. I'm joined tonight by my co-host, Lisa Ward. She's also a certified financial planner professional. Lisa, how are you this evening?
Good, doing well. Welcome, everybody.
Absolutely.
Thanks for coming.
It's going to be a lot of fun. I'm at based in our Oklahoma City office of ChappelWood Financial. Lisa is our lead advisor in the Arlington, Texas office. So she is serving Arlington, Fort Worth, and the greater Dallas-Fort Worth area. And so we're really excited to have all of our friends and neighbors in Oklahoma, as well as our friends in Texas, joining us this evening. A little bit of housekeeping. And what can you expect this evening? Throughout tonight's presentation, you're going to be learning a lot about several different things. We're going to, here, let me change slides. Maybe that would help a little bit. So we're going to be talking about in the first part of the presentation, Lisa's going to guide you through what are some of the biggest changes that we've seen over the last few years that have impacted taxes and more specifically, your money. Later on, we're going to transition to the 4 tax buckets, different buckets of money. Income is taxed differently depending upon the kind of income that it is. So we're going to be sharing how to know which income is more tax advantaged. And then, of course, we're going to close with what does it all mean for you? You know, all the information is great, but unless you can use it for yourself, it doesn't really do you any good. Also, any questions that you have tonight, you can use the chat function. If you have a question, go ahead and hit that chat. You can submit your question today. We've got some people checking in. Angela says hello. Janice says hello. Jan and Chuck say good evening. Good evening to everybody. And if you just want to send us a special message, just a shout out, go right ahead. But please share your questions. We will answer your questions here live. The other thing, we'll have little poll questions throughout because we want to know what you're thinking. We want to know what your thoughts are around taxes. And speaking of poll questions, we have our very first poll question of the evening right out of the gate. So let me launch this poll for you right here. So you should see the poll question pop up. What are you most interested in learning about tonight regarding taxes in retirement? So I would love to share your responses right here on the screen. So hopefully you see that question right there. And let's see what we got. All right. So we've got how it's possible to reduce or eliminate Social Security taxes. Oh, this is fun. This is fun. The questions.
Moving live. Love it.
It is. It is. They're competing. This is really interesting. It's pretty evenly balanced. We've got 25% of the people on who have responded. If you've not responded, okay, here we go. So we'll leave that poll open for a little bit. But what is it that you're most interested in learning? And it might not even be one of these things. Maybe it's something else tonight that you want to learn more about, you want to ask about. So we'll keep it going. We've got some good responses. So far, we've got 50% of you have said how to use my IRA 401k for retirement without paying too many taxes on it. Let's see. How is it possible to reduce or eliminate Social Security taxes? I can promise you, before the evening ends, we're going to share with you a strategy that you can employ, and anybody can do this, that if you could figure out a way to make this happen with enough time and enough planning, you could virtually eliminate taxes in retirement. I know I have your attention on that, okay? So not everybody can use it, or actually, let me put it a different way. Everyone can use it, but not everybody takes the time to plan for it. So stick around for that. All right, we're going to go ahead and close the poll here. We've got a fair number of people that have responded. So we've got almost 54% of you want to know how to use your IRA and 401k in retirement without paying too many taxes on it. Another 31% of you want to know more about how it's possible to reduce taxes or eliminate taxes on your Social Security. And then 15% of you want to know about the 4-bucket tax strategy. And we're certainly going to go into that as well. So let's move on, shall we? And Lisa is going to guide us through a conversation on some of the recent law changes that have impacted taxes. So Lisa, tell us all about all these different laws and this myriad of confusion that Congress loves to hoist upon us.
Oh, absolutely. So back in 2019, we passed the Secure Act. We love a good acronym. So that actually stands for Setting Every Community Up for Retirement Enhancement Act. And that threw everyone in our industry for a tizzy because there were so many changes and continuation of changes. So that's actually what we're going to review. So 401ks definitely were impacted by all of this. So then they came out with Secure Act 2.0 because we were super creative and needed additional changes. But for those folks who are about to retire this year or already in retirement, your RMDs were affected, and another acronym. So that stands for Required Minimum Distribution. And if this is your 401k money or your traditional IRA money, the government says, we want our tax revenue. So therefore, we are going to force you to take money out by a certain age. And it was the age that actually changed. So it is now 73. And then going forward over several more years, it could potentially be 75 for you, depending on when you get to retire. And how they calculate that, it's based on how old you are and the account value at that time. And that's what you're forced to take out. The other thing that changed was the penalty. So previously, if you did not take out your RMD, you were forced to pay a 50% penalty on top of taking out the required amount from your account. And that's pretty hefty. We have penalties in other facets of retirement planning, but 50% is huge.
Yeah, I mean, before they made the change, I think that was the stiffest penalty in the entire Internal Revenue Code. I think that was the most difficult one out there.
Yes. So now they have reduced it to 25%. So they've leaned off of that a little bit, which is good. Some other things that changed were the catch-up provisions. So for a 401k, if you are over the age of 50, you can add an additional $7,500 on top of, go back, Damon. We're not done yet. $7,500 to your max on top of the $23,000. And then for our accounts outside of work, so our IRA accounts, you can add an additional $1,000 on top of the $7,000 for a total of $8,000. So really wanting to ramp up your savings those last few working years before you actually retire.
That's right. If you are looking to maximize and supercharge your retirement savings, the federal government is allowing you to set aside a whole bunch of money in your 401k and your IRAs.
Yes. And previously for Roth contributions in a 401k, which Roth contributions in a 401k is new as well. But previously, if your company provided a match, you had to contribute to the pre-tax portion to qualify for the match. Now you can do all of your contribution as a Roth contribution and still get the match, which is really great. Then we also changed the qualified charitable distributions. That threshold actually increased, which is good. So if we don't want to take our RMDs, we don't need the RMD. Say we've got pension money, we've got our Social Security, we can actually donate or gift the required minimum distribution to our favorite nonprofit. Because they're a nonprofit, they don't pay taxes. You qualify for your RMD amount and you don't pay additional taxes. So it's a win-win. And we feel warm and fuzzy inside for making a difference in our community. Then for annuities, there was a certain type of contract called a QLAC. So more acronyms, we speak like another language over here. So it's a qualified longevity annuity contract. And that allows us to defer taking out from our qualified accounts, so 401k funds, to age 85 because everyone is living longer, we're working longer, and they increased that dollar amount that we can put into that kind of contract to $200,000, which is a great legacy planning tool, but also a tool for long-term care planning. So if we're going to park that money aside, it's dedicated for that. So we've got that in our income plan.
And in case you're wondering, what exactly would I use that for? Let's say you've got $1 million in IRA money, and you're going to have to take required minimum distributions on that $1 million. Well, what if you could set aside 200,000 of that in the QLAC, the Qualified Longevity Annuity Contract? You can defer taxes on that all the way out to age 85, and now you only have $800,000 that you have to take required distributions on now. So it is, Lisa, a great way to try to minimize and reduce the amount of taxable income that you have to take early in retirement.
Yes. Now, for the folks that are a few more years out from retirement, they have implemented the automatic enrollment into your 401k or retirement plans through work with an automatic 3% contribution. Literally don't have to do anything but start the job, which is really nice. The emergency savings is not as common. Most employers have the 401k or 403b plans. Student loan debt. This is huge for folks fresh out of school, or we've just finished grad school and cash flow is tight. We're paying off our student loans and can't contribute to our retirement accounts. You can now complete paperwork with your employer. And if you qualify by paying off your student loans and getting rid of that debt, you can get the match from your employer. So they will contribute to your retirement account while you're getting rid of your debt. And then you can contribute once that debt is paid off, or cash flow looks a little different. So that's massive. And then 529s. This is even, I'm going through this right now with one of my clients. Say you've got a full ride, you're a brilliant student, or you went into the military and you got a full ride, and we have leftover 529 funds. Well, normally you take them out and you pay a penalty on it. Now we have a lifetime of $35,000 that we can roll over into a Roth IRA. So it's the beneficiary that gets to take advantage of this. So it qualifies as your contribution for that year. So for our younger folks, it would be the $7,000. So we can do that over several years, but the money is, it can continue to grow, tax deferred, and then tax free in retirement. So the impact compounds tremendously. So I love that that's available to us.
I do too, because, one thing, Lisa, that we see, if someone was, especially in this day and age when a lot of students are coming out of college and they got a lot of student debt, a lot of college debt, they're paying on that debt, and often they're at the lowest income earning years of their life. So it's difficult to get started investing and setting aside money. What a great way to get somebody who's in their early 20s, that just graduated college, and they've got 529 college savings money left over, roll it into a Roth IRA. Now they've got their education, they're working, and they've got a great start on investing and saving for the future, and with tax-free dollars. And I love that. I love that a lot.
So also that happened was the Tax Cuts and Jobs Act. And this was really to rein in our government spending. We know they're not necessarily good at living on a budget. They don't like that word. But that was the goal of this, was how can we cut spending? But it does sunset next year. So new things are coming down the pipeline depending on how November turns out as to what new fun tax laws will be coming down the pipeline. So how did we experience that over the last few years? Well, in 2017, we had some really high tax brackets. Over the last several years, we have stretched them. So we've increased that threshold. So This example is for a household that made $250,000 in 2017, was in the 33% tax bracket, versus this year, that household would be in the 24% tax bracket. So some savings there, which we all love to hear. And a huge difference was the standard deduction. Look how drastically that has grown for a married couple, from 12,000 to this year's 27. Well, this was last year's numbers, the 27,000. We're at 29,000. Go to the next slide, Damon, for this current year. So if we previously were doing, itemizing, making our contributions to all the things, that threshold has gotten a lot harder to reach. So for some households, we might not reach the 29,200, but if you are, here are some ways that you can meet that. And one of them is the donor advised fund. And so say you've got a really good year, had a big bonus, we've got a taxable event. Well, you can do a massive lump sum payment into a donor advised fund, and then maintain the assets, control what it's invested in, and then over time, donate that to different charities and nonprofits. But in the year that you contribute to the donor advised fund is when you actually take the tax benefit.
Yeah, and Lisa, I've got a great story about the donor advised fund. In fact, it just happened today. One of our clients, David, called up and he's getting ready to sell a building. He's going to sell a piece of real estate and he's going to sell it for $16 million. All right. Now we have to carve off money. He still owes about $6 million on the loan. He's going to have to pay a couple $1 million in capital gains taxes. We're going to talk about that later. But by the time what he's left with is about $7 million. And he has charitable intent. And one of the conversations we had today, and that we're going to talk about next week, is setting up a donor advised fund that he can fund to support his favorite charities. And once it's there, it's a completed gift. And then he can direct where that money goes later on. So he's really excited about the possibility of setting that up. And it's also typically a lot less expensive and a lot less headaches to set up a donor advised fund than to set up like a family foundation. We get that question a lot. Should I set up a family foundation? You can do that, but donor advised funds typically are much easier to set up. There's not as much overhead, oversight. Yeah, just a headache. If you set up a family foundation, you're creating a business, and that business has to be managed and it has expenses and needs staff. A donor advised fund is just a fund, and you can give charitable gifts out of it.
Yeah, so easy peasy there.
Yep.
And as we mentioned before, the qualified charitable distribution, you can do up to $100,000 that qualifies for your RMDs. And that you can do prior to the RMD age. So if we are wanting to make some tax strategy moves, we can actually do that prior to.
Yeah. Another perfect example of this is, hey, we're in Texas, we're in Oklahoma, and a lot of our guests on the call tonight probably have oil revenue. You got mineral royalties. We got a lot of clients that they receive hundreds of thousands of dollars in mineral royalties every year. And then they have tax deferred accounts, IRAs. They have to take those required distributions or else they get penalized, as Lisa already mentioned, but they don't need the income. So we use the qualified charitable distribution, and we literally send out money to, 15, 20 different charities, depending upon how much they have to take. And it's a really, really great tool. And I'm really glad Congress made it a permanent fixture in the tax code because for a while there, they were just renewing it year by year, and now it's permanent.
And some other ways to reduce our taxable income are above the line deductions. So if you are within the threshold for income, and depending on how you file, and if you have access to a retirement account through work, you might be able to deduct your contributions to your traditional IRA. Plus, you've got the catch up of an extra $1,000. They increased the HSA contributions for an individual to over 4,000. And that is a great tool for retirement planning. So it's basically like a Roth for healthcare in retirement. And you can always deduct the self-employment tax that Damon and I get to do. And those that are still paying on student loans, depending on your income level, you can also deduct your interest on your student loan payments from this year.
Yep. I also love the HSAs for another reason. A lot of people don't realize this, but starting at 65, you can actually use the money in your health savings account if you're on Medicare to pay your Medicare Part B and D premiums instead of having that money taken out of your Social Security check and using taxable dollars to pay for that. Use tax-free dollars to pay for your Medicare premiums and your long-term care insurance premiums for that matter. And that way you can preserve your other money to live on and have fun and all that good stuff. So I love an HSA.
And some other changes from 2019 on, the one paying the alimony, it is taxable income to them. And the receiving person, it's tax-free income. Previously, it was the other way around. The one paying it actually got to deduct that and didn't pay taxes on that income. And the one receiving it paid taxes. So it's reverse of that. And then we've got some other ancillary things on here with penalties from taking a CD early. I love that school teachers only get a whole $300. If you know a school teacher, they spend more on their students annually than $300, but at least they get that tax break.
Yeah.
And then for our Army Reserves and our disabled folks, there's some benefits there for them as well. And standard deduction did go up, as it has over the last several years. And the AMT exemption has also gone up, which is really good. So it's an alternative minimum tax that, depending on your scenario with what happens, whether it's bonuses, it's a special scenario where that actually happens. But if it does, we definitely need advisors looking at everything to make sure that we've done things properly. And then the mortgage interest deduction. So if your mortgage is the $750,000 or less, you get to deduct the interest on that. Now that number does go back up to $1 million. So if you have been shopping around or have been thinking about buying that second property or increasing the property that you already have and upgrading, maybe you might want to wait until next year to do that so that you can actually start deducting that interest then.
And one of the things that I'd like to point out on the mortgage deduction, to take the deduction for interest that you pay on your mortgage, that's an itemized deduction, all right? So the only way you're going to get the benefit of that is if you itemize. If you don't, and you use the standard deduction, then the interest that you're paying on your mortgage doesn't really matter. So if the only reason, and we hear this a lot from clients, they say, well, my CPA told me don't pay off your house because then you won't get to write off the mortgage interest. If you don't itemize, you don't get to do that anyway.
Yeah,
and if the only reason you're hanging on to your mortgage is for the mortgage interest deduction, pay off the house. It's not worth anything to you unless you itemize. Again, that's within reason. If you owe $50,000 and you could write a check today to pay off your house, I might think about it, unless it's going to really diminish my cash position, right? So, but again, if you've been told hold on to your mortgage because you'll get the mortgage interest deduction, that's only true if you itemize.
Yes. And going into the estate planning aspect of things, the exclusion for estate tax did increase one more time to over $13 million, which is hefty, but that sunsets and goes back down to $5 million. So if we are in that estate value, we need to do some serious gifting and some serious planning because over the next several years, that's going to look very different. And we don't want the IRS inheriting part of your estate. We want it to actually go where you want it to go.
Yeah.
And then we've got the mandates and the penalties were eliminated for ACA and can't deduct us. But the 529s, previously it was just used for college. But now if you've got a student that goes to a high school preparatory that has a tuition, you can actually use it for your 529 plan funds to pay for that, which is really nice. That
All
was
right.
a lot of information.
Yes, it was. So we've got another poll question here that we want to share with you guys. And so we'd like to know what you think. Who do you believe needs a tax plan? So who do you think needs a tax plan? Billionaires with offshore bank accounts, the millionaire next door, people with IRAs or 401ks, or D, all of the above? And okay, Lisa, I know we have some really smart, intelligent people on this call because everybody is choosing the right answer. So
Yeah, we didn't have anybody that was click happy.
that's right. That's right. Yes. And keep on answering. The answers keep coming in. We're okay. Keep going. If you have an answer, answer. I want to get 100% participation on this. We have 7. There you go. Keep going. Keep going. Keep going. All right. Obviously, yes. Every single one of these people needs a tax plan. You need tax planning. Taxes run through everything, and it isn't just one day a year. Our taxes may be due on April 15th, but your tax planning runs all year long. And so it's very important that you have plans in place to reduce, minimize, eliminate your tax burden, because taxes will eat you alive in retirement. Taxes are every bit, Lisa, as detrimental to retirement as inflation is, in my opinion. And I don't think it's not
If
really an
anything,
opinion.
that might be worse.
Yeah, absolutely. Because inflation, it's run hot here the last couple of years, but over time, the long-term rate of inflation is just over 3%, all right, 30 to 50 years. Taxes can wildly swing based upon who's in Congress, and that can happen, from year to year. So, yes, 95% of you said all of the above. We did have 5% that said people with IRAs or 401ks, and that answer is correct as well. But everybody needs tax planning. So thank you so much for participating in our poll. And I also want to remind you, if you've got a question that you'd like to ask, please put it in the chat. We did have a question from Angela. She says, I've got a question about 401k Roth match. Angela, if you'd like to go ahead and put your question in the chat and share it with the group, I'd be happy to share it here, and we'll give you an answer. But if you'll type that in, we'll go ahead and give you an answer. All right, let's continue on. So what is still important? All right, we've given you a whole bunch of information already, but what do you really need to pay attention to? What are the key things that you should boil this down to really pay attention to? We like to call them the 4 tax buckets, and several of you mentioned that this is what you're really interested in learning about tonight. So when it comes to your money, there are many different ways income and different assets can be taxed, and there are 4 tax buckets. So bucket number 1, fully taxable forms of income. We're talking about income from a pension. It's tax deferred. You haven't paid taxes on it, so when you take that as income, you're going to have to pay taxes on it. Short-term gains. Short-term capital gains are defined as any gain on an asset that you sell that you held for 1 year or less. 1 year or less. And if you sell that asset for a gain above what you paid for it, you will pay tax on that, and you will pay ordinary income tax. And then dividends. Dividends that you receive from stocks that you own, those are taxable. Now, depending upon the kind of dividend, if it's a qualified dividend, which most of them are probably going to be, the good news is qualified dividends are taxed at a favorable 15% tax rate for most people. So I love dividends. Our clients love dividends, particularly in retirement, because you need cash flow, first of all, and they are tax efficient. Then you've got tax deferred. This is the bucket that's like, nobody likes this one. You like it early in life. You don't like it so much when you're retired, because every dollar that you pull out of this bucket is going to be taxable. So if you start looking at your investment accounts right now, and they're all 401ks, 403bs, which are for nonprofit, church, university, school employees. A 457b is basically the same kind of retirement account for city and state employees. Federal employees, if you're a federal employee, you have what's called a thrift savings plan, or a TSP. All of these plans function exactly the same, and every dollar that comes out of them in retirement is going to be taxable if it's a tax deferred amount. What about the third bucket? Now we've got long-term capital gains. Long-term capital gains are any gain that you recognize on an asset that you sell, so long as you held on to that asset for at least a year and a day before you sold it. So short-term is a year or less holding period. Long-term is a year and 1 day. So if you've held on to it for 364 days, just hold on to it for 2 more days. Then you can sell it. All right. And then you'll get long-term capital gains treatment, which for most of you is going to be 15%. Even if you're in the top tax bracket, your top long-term capital gain and qualified dividend rate is 20%. Interestingly enough, there was an article that came out many, many years ago, and it said Warren Buffett pays less in taxes than his secretary. That's not true. Warren Buffett pays a lot more in taxes than any of us here tonight. What the headline should have said is Warren Buffett's tax rate is lower than his secretary, and his tax rate is probably lower than yours as well. And that is because Warren knows, just like a lot of other really wealthy families, they know which types of income are taxed at different rates and more favorable rates. If all of your income is W-2 regular or ordinary income tax, you're going to pay 24%, 28%, 30%, whatever that is. But if you have income that is capital gains, long-term capital gains, qualified dividends, those are going to be taxed at lower rates. All right. So that is how Warren Buffett keeps his tax rate low, even though he's a billionaire. All right. And then finally, we've got our favorite bucket of all, the tax-free bucket. These are distributions in retirement from your Roth IRA. What about municipal bonds? Municipal bond income is tax exempt at the federal level. You don't pay federal income tax on a municipal bond. You pay state income tax. And for our lucky friends in Texas, since you don't have any state income tax, municipal bonds are completely tax-free. There you go. The IRS really does care about you. They give you little crumbs here and there, right? What about life insurance? If you have life insurance and you pass away, your heirs, your beneficiaries receive the death benefit. That death benefit is tax-free. They don't pay taxes on that. And even a portion of your Social Security income is going to be tax-free. So it's important that you understand how different income is taxed, because when you get into retirement, it's more about cash flow management. For most of your life, as you're working and you're accumulating wealth, it's about asset management. Which stocks do I own? Which bonds do I own? Should I own gold? Should I sprinkle some Bitcoin in there? What about real estate? What are the assets that I own? When you get into retirement, you're going to care a lot more about, is the money that I need every month showing up in my bank account? You're going to worry about cash flow. Well, that's important, because not only do you need cash, you need to make sure that it's coming to you in a tax efficient manner. And knowing these buckets will help you to do that. Let's talk about some problems with tax deferred accounts, IRAs, 401ks, 403bs, that sort of thing. For probably most of your life, what have you heard? Defer taxes. Put money into your traditional IRA. You get a tax deduction today, you reduce your taxable income today, and it grows tax deferred. And that sounds like a great deal. However, the bill comes due in retirement when you are least in a position to be able to pay taxes. Why? Because you've given up your dedicated paycheck. And now the paycheck you have is the one you've created with your savings and Social Security and that sort of thing. The problem with tax deferral is that when you get into retirement, if that's all you have, every dollar that you receive is going to be taxable. And this could push you into a higher tax bracket. A lot of people believe, well, when I retire, I'm going to be in a lower tax bracket. My income is going to go down. Really? We have many clients that when we ask them, how much money do you want to live on in retirement? What's the monthly income that you'll need to fund your lifestyle? A lot of them say, well, I want to live on the same amount that I've been living on all this time. Their tax bracket's not going down. So it's not a given that your tax bracket's going to go down just because your income goes down. It's not a given that your income is going to go down. So you need to be aware of that.
Yeah.
Here's
Why
the other
downgrade in retirement? We need to upgrade.
Right. And get this. The first few years before retirement and the first few years after you retire, that is when you're going to spend most of your money. Okay? Because what are you doing? You're traveling, you're renovating the house, you're buying the RV and the boat and all the toys that you want. You're spending money on the grandkids. You're starting a hobby. You know, I got a client that they sold their house and they went and built a barn dominium and they lived in the barn. They thought, well, now we want a house. And so they went and built an $800,000 house. Trust me, their life isn't getting simpler in retirement. It's more complicated, right? These distributions from these accounts can also lead to additional tax on your Social Security income. We're going to talk about that here in just a second. These distributions can lead to more tax on your capital gains. Again, the higher your tax bracket, you could move from a 15% capital gain rate to a 20% capital gain rate. The only accounts that required minimum distributions come from are your tax-deferred accounts. If you didn't have any tax-deferred accounts, the government would not be telling you when you have to take your income, even if you don't need it. And if the money you're going to leave to your beneficiaries, your family, your heirs, is tax-deferred, they're going to have to pay the tax on that money as well later on in life. I want to check here. Okay, you've answered Angela's question. Thank you, Lisa. That's great. All right. We want to spend a little bit of time here talking about what we call the IRA exit strategy. And I'm going to have Lisa go through this with you. But this is a very simple strategy that a lot of people use, but you may not have really thought about it this way. You've got a lot of traditional pre-tax IRA money. How do you get it over into the Roth IRA bucket? So Lisa, share with us, what does this look like and what is this?
So thank you, Damon. It's a Roth conversion. So you might have heard that, but how we look at it is, so if we're still working or we've just retired, how do we create tax-free income for the future? And if we want to stay within a certain threshold for taxes, then we run that analysis. So if we don't want to roll over all of our $1 million, because the government would get way too much. So let's see what can we budget for over a certain time frame to convert our pre-tax to after-tax dollars. And there's several benefits to this. You'll go to the next slide, Damon. We'll go over, why do we actually do this? One more. There we go. So advantages of this. So we do have to wait a 5-year period, but if we've done our income plan correctly, we will be fine. But we can move larger lump sums into emergency savings. We can use it for long-term care in the future. So if we do have an event that comes up and we need to take additional funds out for that, it won't create a taxable event because it's already after tax. And we will show you an example of this for how this affects your Social Security benefit. So if we have basically all tax-free income, then there's nothing else to claim except for the Social Security benefit. And RMDs are not required from a Roth IRA. So the government is not telling you how much to take out, how to spend it, when you can spend it. It's also a great thing for legacy planning. So something that did change with inherited IRAs. So if we wanted to leave 401k money to the next generation, we used to be able to stretch it and stretch it and stretch it and just keep on passing that bucket down. Now, if your non-spouse inherits taxable accounts, they have to spend that down over a 10-year period. And think, if we've had parents pass away, we are very established in life. We're doing really well. If you had to then add on an additional $100,000 plus to your taxable income, we might jump 2 tax brackets. That totally throws your plan, out the window. So Roth IRAs don't just affect you, but they also affect the next generations and continuing to build that wealth. And it reduces the estate tax issue. So Roth IRAs can fix lots of problems, but we need time to plan for them.
Yeah. And one thing that there are several things that I love about Roth conversions, but especially right now, because as we already mentioned earlier, the tax rates right now are lower than they will be starting in 2026. So the Tax Cuts and Jobs Act that Lisa talked about at the beginning lowered the tax rates on 5 out of the 7 tax brackets. That will sunset, and starting January 1 of 2026, the tax rates go back up. You are going to have to pay the tax on your IRA money eventually. The only question is, do you pay it now? Do you pay it later? Right now is potentially a great time to consider a Roth conversion, because when would you rather pay the tax on your IRA money? Now, when the rates are lower, later, when the rates will most certainly be higher? It's a pretty simple question to answer. So that's one reason to consider a Roth conversion. There are no RMDs on Roth, so you don't have to take required distributions on a Roth. However, there are 2 other really good reasons, and one we're going to discuss here in a moment. She just mentioned the possible reduction of tax owed on your Social Security benefits. A lot of people don't realize, but up to 85% of your Social Security benefit can be taxed in retirement. And one of the biggest reasons for this, or one of the biggest triggers for this, is your adjusted gross income, your taxable income. So first, let's go through how your Social Security is actually taxed. And we do have some questions over here in the chat. We're going to get to those in just a moment. But let's discuss how your Social Security is taxed, first of all, and then what role does the Roth play in it, okay? So I promise this is all connected. To determine how much of your Social Security is taxed, the IRS is looking at what's called your provisional income. Essentially, this is just adding 3 numbers together, and depending upon the sum of those 3 numbers and your tax filing status, that will determine on whether or not you pay tax on your Social Security. Here's how it works. They add 3 numbers together. The first number is basically all of your taxable income. If it's taxable income and it's part of your adjusted gross income, that number goes in there. The second number they add in, remember all of that tax-exempt income from your municipal bonds that I talked about earlier? Well, for purposes of this formula for taxing your Social Security, it's included in this. And then the third number they add in is 50% of whatever your Social Security benefit is. Now, they add those 3 numbers together. So here's how this works. Let's start on the left-hand side. Let's say that you're a single taxpayer, you're head of household, or you are a qualified widower. If the sum of those 3 numbers is less than $25,000, you will not pay any tax on your Social Security benefit at all. If the sum of those 3 numbers is between $25,000 and $34,000, you'll pay tax on up to 50% of your Social Security. And if the sum of those 3 numbers is greater than $34,000, not even $3,000 a month, up to 85% of your Social Security benefit will be taxed. What if you are married filing jointly? The same basic concept, but the income thresholds are a little bit higher. If the sum of the three numbers is less than 32,000, no tax on your Social Security. If it's between 32 and 44,000, 50% of your Social Security is taxed, and greater than $44,000, not even $4,000 a month, up to 85% of your Social Security benefit can be taxed. You begin to realize that if you want any kind of lifestyle at all in retirement, it's virtually impossible to avoid this. It's virtually impossible to avoid paying the maximum amount on your Social Security. So what can you do? Well, for one thing, you can try to target those more advantaged streams of income, like long-term capital gains, municipal bond income, qualified dividends. Yeah, you're going to have to pay taxes on them, but those are lower tax rates. But what if you have Roth distributions, Roth income? Well, since those Roth distributions are tax-free, they're not counted in your adjusted gross income. And as a result, they're not counted in this formula. Earlier, I said I'm going to share with you a strategy for virtually eliminating your taxes in retirement. With enough planning and enough forethought, if you got into retirement and the only streams of income you had were distributions from Roth IRA accounts and your Social Security benefit, under current law, you would virtually have zero tax in retirement because the Roth distributions are tax-free and they don't count towards this formula to tax your Social Security. Now, most people don't do this, but it is possible. And we want you to know what's possible under the tax law. You know, the tax law, it taketh, but it also giveth. And you don't have to let it be a weapon that bludgeons you in the head every April 15th. You can use it to your advantage so that you can minimize your tax burden in retirement. We do have a question here from Daniel. What's a good Roth IRA company to switch to? Well, really, Daniel, any investment company can host an IRA for you. Some of the most common names out there, everybody's heard of Fidelity and Vanguard and Schwab, those kinds of things. Those would be self-directed IRAs. We have our own companies that we like to work with. So it really doesn't matter. What really matters is the quality of the investments that you're owning inside of the Roth IRA. That's what really matters. That's what really matters. He says,
Daniel,
I'm with Edward.
Go ahead and just click the button, book a call. We'll
Yeah,
talk.
Daniel, we can talk. Okay, we can absolutely talk about that. And he says that his current advisor is horrible. It really comes down to, what is your advisor talking to you about? Are they educating? Are they giving you options? Or are they just, overloading you with stocks and bonds and mutual funds? It isn't just about the investments. It's about the taxes. It's about cash flow, particularly in retirement. So let's go through an example here. So Lisa, lead us off. Show it. Now let's get into this example of a couple that is dealing with 100% taxable income.
Yes. So we've got John and Mary. They're both 65. And their tax rates, because they do not live in our lovely state of Texas, is a 4.63 state income tax, and then they're 12% for federal. So their goal in retirement is to have $66,000 of income, and they receive $36,000 from Social Security. So we need to then take out $30,000 from our 401k, which is all taxable. So the $66,000 is completely 100% taxable. So what does that, wash out to be? So 48, almost $5,000 from the 401k tax. And then Social Security, because of our income threshold, 85% of it is taxed. It's $3,600 for a grand total of $8,661 in taxes.
And this is one.
If you do something else, like this next couple.
That's right. Well, and actually, let's say John and Mary changed up their strategy a little bit. So right now, in this example, all the income they're taking is 100% taxable. Remember earlier I mentioned to you, retirement planning is more about cash flow management than it is asset management. This is a perfect example of what I'm talking about. Cash flow management based on time, but also taxes. What if you could divert the flow of the river? Okay. What if you could divert the flow of the income instead of all coming from one place, all taxable? What if you could have a little side river that wasn't taxable? Check this out. So here's John and Mary, same situation. They still have the $36,000 in Social Security, but this time, instead of taking the $30,000 from their IRAs, they've got some cash sitting over on the sidelines, or they've got a brokerage account, a taxable brokerage account that they pay capital gains and the taxes on income. Instead of taking it from the tax-deferred 100% taxable account, you can take it from the non-qualified savings, which has already been taxed. You pull that $30,000 out, you have the same income, the same $36,000, but you have cut the amount of taxable income in half. You have cut the amount of your Social Security that is being taxed by 35%. So that now the taxes that you owe are not $8,800. They're now $2,160. And all because you made one simple change. You diverted the flow of your income. You diverted the flow of your cash from a different bucket that is not taxed nearly as heavily. Not a lot of people know how to do that themselves. A lot of people do. Perhaps you already do, but a lot of people don't. And we see it all the time. And this is one way that you can significantly reduce your taxes in retirement. So you see here, they saved $6,501 simply because they practiced good cash flow management. And probably more to the point is they probably worked with their financial advisor, their CPA, to make sure that they did this. So what does this all mean for you? Well, all of you are here tonight. You wanted to come and learn about taxes, and that's what we talked about. But ultimately, we know that all of you have one deep-seated fear. It's the number one fear that everybody has, and that is, I don't want to run out of money in retirement. Okay? So how do you not run out of money? How do you not run out of money? Well, you have to have an income plan. You need to have a plan for how you're going to generate cash flow, and then a plan for how's it going to come to you. This is a cash flow plan, an income plan from an actual client, a real client that we work with. When they started this plan, you see the little donut there, they had $3.3 million. Now, what we commonly see is a lot of people take all that money and they stick it in there and they just manage it all the same way. We don't do it that way, and you shouldn't do it that way. You don't need all of your money at any one given point in time. You need some of it now, you need some of it later. Does it make sense to manage money you need tomorrow the same way you manage money you need 20 years from now? No. So in this example, we split up the 3.3 million into different phases of their life. Years 1 to 2, years 3 to 10, 11 to 20, so on and so forth. Each bucket targets a different phase of their life when they actually need the money. It ranges from the far left, most conservative, we need it sooner, to most aggressive, we need it several years from now. Each bucket is targeting different rates of return and using different kinds of assets. On the left-hand side, you're going to find more cash and bonds that generate a lot of income. On the right-hand side, you're going to find more aggressive growth stocks that maybe don't pay a dividend, but they've got more opportunity for growth. This is one way, the way that we use, so that you don't run out of money. Again, we don't know what the assets are in here. We don't really care what the individual stocks and bonds and mutual funds are. That's not the point. The point is, once we know how much income you need, and we know the time that we need to cover that, we can build this out, then we can choose the assets that need to go into each bucket. And that's how you plan for retirement. Then, what's your cash flow going to look like? Okay, so we invest all the money. So how am I actually going to get it? In their case, they both retired at 57, pretty young, right? And we showed them that for the first decade of their retirement, they could pull from their investments, which are the blue bars. And then starting at 67, which is what? Full retirement age for Social Security. their Social Security comes online. That's the baseline income. Almost everybody on the call is probably going to have Social Security, unless you're under the old civil service federal pension plan. All right. Perhaps you have a pension of some kind. Perhaps you have a fixed or an indexed annuity that is protected money, and you're going to turn that on later for income. And we use that strategy a lot for our clients who want protection. All right. It's not a growth strategy. You shouldn't use an annuity at all if you want growth and that's your primary objective. All right. And then you notice that the blue bars, they don't have to take as much, but then as time goes by, they have to take more and more and more. Why? That's the impact of inflation. And in this case, 3% inflation. They have to take more out with each passing year to maintain their purchasing power. A plan like this, it's not a guarantee you're not going to run out of money, but it's a great framework to make sure that you're on track and you're far less likely to run out of money. So let us launch our next poll question. Do you think taxes will increase in the future? Simple yes or no. Do you think they'll increase in the future? And this one seems to be a pretty simple question to answer.
Mm-hmm.
It's kind of an open book.
It.
I was going to say, it's an open book test. All right, we've already given the answer. Taxes, yes, are going up again here in another couple of years, but who knows what Congress is going to do?
Mm-hmm.
You know, Lisa, I was reading an article not that long ago that was talking about 401ks could disappear in the next 10 years. Your 401k plan may not exist 10 years from now. Now, the money in it will still be there, but there are factions within our federal government that are talking about eliminating the 401k and eliminating the tax deferral. You get to keep the money, but they're going to make you pay the taxes on it. You would still have an employer-sponsored retirement plan that you put money into, but it will no longer be tax deferred. Why? Because the federal government wants its tax money now.
Yep.
They want the money.
Not willing to wait 20, 40
That is exactly right. So 100% of our respondents said yes, taxes could be higher in retirement. Doesn't mean they will, but taxes could be. And we know the tax rates are going back up here in another couple of years. So what comes next? This is the point in time where a lot of people are, you've gone through this and you've seen all this and you're like, okay, my God, this is a lot of information. How do I keep track of this? How do I make heads or tails of this? And so this is what we want to offer to all of you who qualify on the call tonight. There's no obligation to do this. However, it is something we want to offer. If you have saved at least $500,000 of investable assets for retirement, and we're talking cash, 401ks, 403bs, retirement plans, IRAs, investment accounts, CDs, anything that can be invested. And you have gone through this and you've been thinking, I could really use some help. I could use a second pair of eyes or a third pair of eyes looking at this, giving me some guidance. Click the button. Take advantage of this. You're going to speak with a member of our advisory team, and you're going to be scheduling a 30-minute phone call with us. Just 30 minutes. That's it. That 30-minute call, you're going to provide some details. Our team will ask you some questions. We want to try to get a basic idea of where you're at in life, what you're trying to accomplish, and how we might be able to help you. From that conversation, we'll schedule a more formal appointment. We can do it in person. We can do it via Zoom. Technology is a wonderful thing, right? It's really up to you. But what you're going to get out of this initial appointment, and it's not going to cost you anything. We're not charging for this. This is complimentary because you've taken the time to attend tonight's presentation. You're going to receive a personalized income plan and tax analysis. Perhaps you have some accounts that if you were to transfer them over, if you were to consolidate your accounts and you sell those assets, you're going to trigger a bunch of taxable capital gains. Is there a better way to transfer those without triggering all that? The answer is yes. And we can actually show you how we can do that and potentially save you thousands of dollars. Once we present all that to you, we'll tweak it. And then once you've got it where you like it, we implement the plan, and then you go and enjoy life. So what are you going to receive out of this? Well, first of all, you're going to get an answer to the question, what are my odds of running out of money in retirement? Because that's what the income plan is designed to answer. What are my odds of running out of money in retirement? Nothing's 100% certain. But if we can get it to 90% or better, that's pretty solid. You're also going to get a report detailing the potential tax dollars you could save by transitioning your taxable investment accounts. Again, this doesn't matter with IRAs. There are no taxes in that. But if you have a trust account or an individual investment account or a joint investment account with a spouse or some other person, and if you were to sell all that, then transfer the cash, capital gains. We're going to show you how you don't have to do that. You can actually transfer it, and then over time, we can incrementally and strategically transfer all those assets and transition them. In addition, we're going to give you some simple recommendations for addressing your other wealth management needs. There's a lot more to your retirement plan than your portfolio, right? What about Social Security optimization? You've got Medicare questions. We can help with that. Maybe you don't have your estate plan in place, or it's old and it needs to be updated, and you need some guidance on that. Maybe you've got questions about long-term care. How will I pay for the possibility if I have to go into a nursing home? How much will that cost? All of these things are a part of your entire retirement picture. It goes well beyond your investment portfolio. And that's what we're here to do. This is what we do for our clients at ChappelWood Financial all day, every day. So to take advantage of this offer, click the button that says book your call. A member of our team will get back to you. There are a handful of dates available, just a 30-minute phone call, and we'll take the next steps after that. Thank you so much to everybody for joining us. We hope you enjoyed it. Hope you got a lot out of it, and we look forward to speaking with you in the weeks to come.